Hi friends, with the Democratic National Convention in the books, the Republican National Convention yet to come, and less than 90 days left until the November 3rd election, we wanted to focus in on something that is getting a ton of attention both to investors and voters, and that's the Biden-Harris Tax Plan. It has a lot of nuances in it, and in fact, an independent study showed that the Biden-Harris tax plan is expected to generate an additional $4 trillion in tax revenue, which is a huge step up from Hillary Clinton's 2016 tax plan, set to generate $1.5 trillion. So it's nearly triple in terms of tax revenues. Now, there's 5 major parts to this plan. The first and foremost, which is the easiest to discuss, is the raising of the highest tax bracket from 37% to 39.6%. And here's what's important to note. It took an all-Republican House, Senate, and White House to get any tax legislation through. And that's where most investors are concerned. Not if the Democratic Party were to take the White House, hold the House of Representatives, and not take the Senate. Right now, the Republicans have a 53-seat majority in the Senate. But the scenario where most investors are thinking through is what happens if there's a Democratic sweep. So number one, in a Democratic sweep, they would raise, likely, the highest tax rate to 39.6%. Number two is they want to raise the corporate tax rate from 21 to 28%. Keep in mind, though, Wall Street would view this as a win because just 3 short years ago, the highest corporate tax rate was 35%. So now, instead of conversations being framed in the 21 to 35% future corporate tax rate, if the Democratic Party were to hike the corporate tax rate to 28%, now the window is smaller. Now future tax policy conversations likely would focus on a 21 to 28% corporate tax rate. Again, Wall Street would see this as a victory. Number 3 and number 4, and they go sort of together. Number 3 would be the elimination of the step up at death basis benefit. That's a mouthful. Just means when you pass away and you leave non-retirement assets, whether it be real estate or investments, to your beneficiaries, they get to step up whatever your cost basis was in it at death, effectively eliminating what would otherwise be a potentially very high taxation. Now, while this is getting a lot of attention, this would be an absolute nightmare for the processing systems and Washington, D.C. in general. This is highly unlikely to happen. What would be more likely is that the estate tax benefit, which currently sits at $23.16 million for a married couple, would fall significantly down to single-digit millions for couples. Now, number 4 is the taxation of dividends instead of at the 15% rate, and in some cases it's 20% depending on your income rate, but to tax it at ordinary income. Income on dividends has not been taxed that high since the early Jimmy Carter days, and even he thought that kind of taxation, ordinary income, which we've already mentioned would likely be 39.6%, would be far too much because remember, dividends are effectively double taxed. The company issuing the dividend pays taxes, and then the investor pays taxes. Again, this is likely, even in a Democratic majority Senate, this is likely not to get traction. Number 5, and this is the one that could potentially have the largest implication on investors and the economy. It's the additional payroll tax. Right now, Social Security taxation is capped this year at just over $137,000. That means on every dollar you earn above that, you're effectively getting a 6.2% raise because you don't have Social Security tax. Vice President Biden has, in his tax plan, laid out that on wages above $400,000, they would add the 6.2% payroll tax or Social Security tax back in. So you'd have it all the way up to the threshold, you'd have a gap, and then $400,000 income earners would have a reinstated 6.2% tax, which is effectively now adding 6.2% onto 39.6%. That's a nearly 46% top tax rate. We haven't seen those rates in almost 40 years. You had to go back to the mid-1980s to see that. Now, here's what's most important about that payroll tax. It does not flow through normal Senate Budget Committee rules. You need a 60-count vote to pass anything dealing with Social Security. It is almost impossible to imagine that either Republican Party or the Democratic Party would have 60 seats in the Senate come November. Now, remember, whether you're on the left or the right or neither, no one election breaks a democracy like the United States. And before you know it, after 2020, we'll be looming down, staring at the 2022 midterms. And before you know it, we will be at the 2024 election. So while certainly if the Democratic Party sweeps, there will be an increase in taxes, they won't be fast enough and they won't be high enough to slow down the growth engine that is the American economy in any kind of meaningful way. Remember, the previous times where Democratic Party has had a majority and raised taxes, look at President Obama's first term, no recession was caused. We are not concerned about some of the potential tax rates that may or may not lead to higher overall taxes causing a recession. So please remember, whether it's this way or that way, there is always an environment where you as investors can protect and grow your wealth. Thanks for watching. I'll see you next time.